With that major tax cut taking effect on July 1, slashing the stock transaction tax under the Capital Markets Efficiency Promoting Act, or SEMPA, many are asking, will it be enough to re-energize trading, attract foreign capital, and bring the Philippines Stock Exchange closer to its ASEAN counterparts? Joining us now to weigh in on this is RCBC's chief economist, Michael Ricafort. He's here to talk about market reaction, investor confidence, and what this signals for the broader investment climate. Hi, Mike.
Hi, good morning, Mike, and to your viewers. Nice to be back.
Good to have you, Mike. Mike, with the implementation of SEMPA, or the Capital Markets Efficiency Promotion Act, the stock transaction tax drops from 0.6% to just 1/10, almost zero. From an economist's perspective, just how big of a deal is this? And will it be enough to spark real momentum in our capital markets, or is it just one piece of a bigger puzzle?
Well, it could be the latter. Although it's a step in the right direction, almost no tax, 0.1%. And it's a savings of 0.5 from 0.6. So, the big funds, it's really meant to attract more international funds in the billions of pesos or dollars. And, this is it's like a savings for them outright. It's like a gain of 0.5. That's on the stock transaction tax alone.
Yeah.
And on top of that, there's also reduced documentary stamp tax from 1% to 0.75 on other transactions, especially new issuances. So, combining the two, that's easily a windfall of 0.75. And that's a big deal. It's hard to earn that much for really huge funds. You're talking about pension funds, retirement funds, trust funds, wealth funds, insurance companies from all over the world. So that hopefully this would increase the volumes in the local stock market. Since this would start in July, let's see in the coming months if indeed this is enough to increase liquidity, because that's very important to have the big funds with their big buy and sell transactions, for them to have better price discovery, to have narrower spreads. They have greater flexibility to invest into the Philippines and nimble enough also to take profit. So, we'll see if the liquidity would eventually also be bolstered.
Yeah, you'll need to be able to put in and take out with ease. On another front, Mike, the Philippines is now off the E-watch list. We're also off the FATF gray list, and we maintain an A- rating with the Japan Credit Rating Agency. How significant is this trifecta for investor confidence? And could it translate to lower borrowing costs, more capital inflows, and stronger remittance channels?
This is all steps in the right direction, Mikey. First is the reform measures with the SEMPA. Then a few months ago, we have the Create More on the FDI side for foreign direct investments. And now, the removal from the watch list of the EU of the Philippines. Well, this doesn't come as a surprise. It's like 2 to 3 months since the FATF also removed the Philippines from the watch list. So that's a good signaling from the point of view of foreign investors, because global investors and regulators are keen on these factors, especially now that investments around the world are encouraged by both international and local regulators for investors to patronize countries, companies, businesses, and other institutions, other issuers that comply with ESG standards, meaning standards that are friendly to the environment, friendly to society or social, and good governance, because this is a good signal on stronger institutions, good governance. But what triggered this positive development on the removal of the Philippines from the watch list when it comes to from the point of view of FATF 3 months ago, and from the point of view of the EU? So, the proximate cause has been the ban on the POGO. So, meaning to say, the Philippines is moving towards that direction. So, it's not really about the money. Well, it's really governance. So, if indeed, that sends a very good signal, because global funds are becoming more ethical and more inclined on the ESG standards. So, That's part of their criteria, among many other things. And
Mm-hmm.
the credit rating agencies. That's like again another positive factor. The affirmation by Japan's Japan Credit Rating Agency of the A minus. It has been there for 5 years already since well, it started at the height of the pandemic, and the other Japanese credit rating agency are like also A minus,
Yeah.
and even the Western credit rating agencies, S&P, now at triple B plus. That's and we already have a positive outlook since November 26. So this is a also the one of the main scorecards used by global investors and creditors for the Philippines before they put in billions of pesos and dollars into the country, into the financial markets, and before lenders also uh, provide credit to the country, to the government. They look at this single scorecard.
And
That's
Mike, going back to the SEMPA, it includes a cut in documentary stamp tax, added incentives like retirement, contribution deductions. This is all aimed at beefing up the capital markets over time. When do you think we'll start feeling the full impact of these reforms?
well, we'll see. It's July 1. It's not that far. It's a little over uh, 2 weeks from now, and well, in the coming months, we'll see if in the latter part of the year if there would be tangible effects already on this, because But there are other things to consider. But at least the important thing is the reform measures are moving. SEMEPA, create more, to create an environment that's conducive for business, for investments to come in, create jobs, create more opportunities. That's the job of the government to come up with more reform measures. And of course, we have to balance this with the fact that, yeah, recently there are noises, and question is, would there be some distractions? But hopefully not, because CIMEPA has been pending for like even before the pandemic, and finally it's passed. So despite all the political noises, even since late last year, so this is good signaling again for the country. And going forward, of course, it's going back to the basics. Well, of course, stronger rule of law, stronger
Yeah.
institutions of law, and of course, it's important that openly political noises would just be noises.
Yeah,
There's no
Mike,
reasons.
exactly on that. Political noise and the rule of law. The House and the Senate remain deadlocked on how to move forward with the possible impeachment of Vice President Sara Duterte. How do you assess this political noise as an economist? Is it scaring away investors at this level?
Well, this is part of democracy. It's a part of the democratic processes that's expected. Well, and well, what's really important is that there won't be risk of destabilization, and there's no risk to the duly elected government, especially on the presidency. That's the most important thing, and the democratic processes are respected. So that's the bottom line. And well, it's better to have no political noises, definitely. Well, on top of that, even before the billions of pesos and dollars, before they're invested here in our financial markets, in the stock markets, as well as in the FDIs coming in. Uh, well, part of the consideration also, of course, on top of the favorable credit ratings, that's 1 to 3 notches above the minimum investment grade, and they're also looking at other geopolitical risks, such as the tension, the territorial disputes between China and the Philippines, because bottom line, they're here to make money. That's the reality about it.
Yeah.
Well, better if there are no political noises. Better if there are no tensions on, well, especially particularly the territorial disputes between the Philippines and China. Because key question would, before they come here to the Philippines in a big way, they would assess, of course, would they make money, the costs involved, and some risk. Would there be a risk of war? So it's a holistic approach. But generally, as long as they all balance out these positive developments on the reform measures, the fundamentals of the country, the profitability, the valuations. It's a timing issue also, Mikey, in the coming months. PSC has been like stuck in a range of 6,000 to 7,000 for 13 years on a year-end basis. And we're kind of near the lower end. We're about 6,300. So timing wise, if they would like to come in here in a big way, in a bigger way. So, well, it's
It's an
favorable.
attractive level because we haven't really budged in the last 13 years.
Yeah.
Now, Mike, talking about monetary policy, the Banco Central's Monetary Board is going to be meeting on June 19th next week to talk about interest rates. Do you think that a 25 basis point cut is warranted at this point, especially with May inflation coming in so low at 1.3%?
Yeah, very much possible, Mikey. You know, it's the third straight month that inflation was well, it's below the target range of 2 to 4% that's set by the BSP. So meaning to say, if it's below 2%, the lower end, so there's a need to bring it back there. To, but you know, there are other factors like the high base effects. But nonetheless, they all have the monetary authorities. They have all the leeway. They have all the flexibility, the room to maneuver, and cut rates, and well, from 5.5 to 5.25, effectively bringing the spread to or the differential with the US at
Very narrow.
0.75. Yeah, that's
Yeah.
the narrowest ever. 2 years ago, that's the last time. So it's well, so they can do that. And for the coming months after that, after June 19 on the possible cut, quarter point cut, it would be now largely a function of future Fed rate cuts because other central banks are doing the same. They're maintaining healthy interest rate differentials. But nonetheless, it sends a signal that the priority still is uh, how to spur greater economic growth by way of monetary easing, lower credit costs, lower borrowing costs brought about by this monetary easing
Yeah.
and rate cuts.
And
So,
Mike,
yeah,
we don't have that much time. Can you give us a snapshot of how you think the economic situation is going to look as we approach the second half of the year in terms of GDP, inflation, interest rates? How much of an easing cycle? How deep might this easing cycle be? And what's the impact going to be on the peso and on the stock market? Can you give us your your outlook for the second half across the board?
well, GDP still close to 6%. It's still among the fastest in ASEAN and Asia, nonetheless. You know, because largely because of the external factor brought about by higher U.S. tariffs and the trade wars, because of the uncertainties on exports and you know this capacity. There's inventories being managed and investments are on the sidelines. Wait and see. So that's number one. So how would it impact? You know, relatively softer economic conditions worldwide would warrant further cuts in rates worldwide also, starting with the Fed. It has been signaled by Fed officials through the dot plot in recent months and also by the Fed Fund futures. Possible cut, well, two Fed rate cuts of 0.25 each. So that would be zero point 0.5. That's also consistent with the recent signals locally uh, in recent weeks. Possible additional 50 basis points cut in local policy rate from the current 5%. Eventually, it's going to go to 5%. Estimate for the exchange rate, it has been fairly stable now at 55 levels. So towards the end of the year, so familiar levels at 55 levels possible, possibly a range of 55.50 to 56.50. But it would largely be a function of the weaker dollar. The dollar's already at the lowest in like 8.5 months in the region in Asia and the lowest in 3 years versus the euro. So I mean, you know, whenever the Fed cuts rate, so the tendency is for the dollar to correct lower because yeah, it's retracing what has happened over the past 3 years when rates were higher, dollar went up. Now Fed rates are going down, dollar is correcting lower. So that's the part of the economic cycles. And well, you know, for the index, it's possible still to move towards 7,000 because you know, hopefully we have seen the worst already in Trump's tariffs, and that has been the view that it's taco. Trump always chickens out, and there's a possibility that the threats may be eventually there may be compromises on a positive in a positive way, and we have seen the worst already, like more than a month ago when at the height of the U.S. China tensions, when tariff set by the U.S. was 145% on Chinese imports. Now it's down to 30%. And, you know, the negotiations are still ongoing. There's possibly the only thing that we have, only risk factor, came out a few minutes ago, you know, there's in the Middle East, the, well, the Israel's attack on Iran's nuclear facility, because yeah, you know, there were threats about 1 to 2 days ago that possible retaliation by Iran, signaling that there's a risk of for them to retaliate and attack U.S. bases in the region. So that has been signaled by the Trump administration on in assessing the security risk also in the Middle East, as far as the U.S. personnel are concerned. So yeah, oil suddenly spiked to $73 per barrel for the NYMEX, coming from like 63, 64. It's up by almost $10. So you know, yeah, that could be a consideration on, say, the
Lots
policy
of things to take
meeting.
into stock. Yeah, but thank you.
Yeah.
Thank you, Mike, for giving us a clearer picture of what's ahead.
Thank you so much, Mikey, and to your viewers.
All
Have
right.
a
Thank you,
pleasant
Mike
morning.
Ricafort, Chief Economist of RCBC.